What's up, legends? Let me ask you something. Have you ever felt like no matter how hard you work, your money just disappears? Like every paycheck is already gone before it even hits your account. You pay the bank, you pay taxes, you pay bills, but who's really getting paid? And here's the question nobody dares to ask. If every country, every company, and every person is in debt, then tell me, who is everyone actually owing? You see, this video isn't about numbers. It's about your life, your struggle to stay afloat in a system designed to keep you chasing stability that never comes. Because while you're fighting to escape debt, the system itself is designed to feed on it. By the end of this video, you'll understand why governments never plan to pay off their debt, and how that silently affects your savings, rent, and future. Why the system needs you to stay indebted, and what you can actually do to step outside that cycle. And the most shocking part, how the money you think you own might actually be someone else's debt in disguise. So don't skip this one, because if you leave now, you'll keep living in the illusion. But if you stay till the end, you'll finally see the pattern that runs the entire world's economy. And maybe, just maybe, you'll understand how to break free from it. Let's begin. The global debt paradox. If everyone owes money, who is owed? Every nation on the planet is in debt. The United States currently owes more than $38 trillion, marking the highest amount in its history. The European Union has a debt around $14 trillion. Japan's debt stands at nearly $9 trillion. Even wealthy oil nations like Saudi Arabia and manufacturing giants like Germany and China carry significant debts. However, this creates a paradox. If everyone is in debt, who is actually owed? This is where the study of financial history comes into play, highlighting the intersections of money, power, and history. Things are rarely as straightforward as they appear.
Debt is not merely a liability. It forms the foundation of the contemporary world. Every conflict, crisis, or economic fluctuation is built on this unseen framework of IOUs. If you trace the network of creditors deeply enough, you uncover a disquieting truth. The world owes money to no specific entity. It owes itself. Nonetheless, that doesn't imply that everyone reaps the benefits equally. Historical context and the birth of sovereign debt. To grasp how we arrived at a situation where a planet is submerged in over $315 trillion in total debt, nearly 3 times the size of the global economy, we must look back to the origins. Long before the introduction of credit cards or digital transactions, the concept of national debt emerged, not from Wall Street, but from warfare. In 1694, as England was engaged in conflict with France and depleting its gold reserves, King sought assistance from merchants. In return for a consistent flow of interest payments secured by future taxes, they financed the monarchy. To oversee this new financial arrangement, the Bank of England was established. This was groundbreaking. The government could now spend money it did not possess. In exchange, lenders received a valuable guarantee from the state, one that could be traded, exchanged, or sold. This marked the inception of the government bond, the foundation of the contemporary financial system. France emulated this system. The Netherlands improved upon it. The newly independent United States adopted it to finance its revolution and subsequent westward expansion. National debt transformed from a sign of failure into a symbol of credibility. The capacity to borrow indicated the power to govern. Empires, which once seized land to acquire gold, now issued bonds to generate interest. The battlefield shifted from physical confrontations to financial statements. Unpacking the creditor, the circular system. Jump ahead 300 years and debt has emerged as the primary export worldwide. The national debt of the United States stands at $38 trillion. While Japan's exceeds $9 trillion. Additionally, global borrowing rises by about $1 trillion every 100 days. Every nation is in debt. Every financial institution extends loans, and every individual, through taxes, savings, and retirement funds, acts as both a borrower and a lender. But who is it that possesses the other end of this financial equation? The United States, debt to itself. Let's begin with the United States, as its debt extends beyond national borders to a global scale. From the total of $38 trillion reported, approximately half is held publicly, indicating that it is owed to investors rather than to various government entities. About 2/3 of those investors comprise American banks,
pension funds, mutual funds, insurance companies, and the Federal Reserve itself. The other one-third, around $9 trillion, is owned by foreign investors. Japan is the largest holder with nearly $1 trillion, followed by China with approximately $800 billion, and then the UK, Luxembourg, and Belgium. Thus, when people say that the US owes money to China, it is accurate, but that accounts for only about 2% of the overall debt. The majority of what the US owes is owed to its own citizens. The Treasury issues bonds, which are purchased by banks and funds. The Federal Reserve frequently buys these bonds back, generating new dollars in the process. American taxpayers contribute through taxes that cover the interest on these bonds, which then benefit American retirement accounts. It's a circular structure. The debt is indeed substantial, but the creditors are largely a reflection of the same financial system, the global interlocking of IOUs. This circular pattern isn't limited to just the United States. It's a worldwide phenomenon. Japan provides loans to the US via treasuries. The US, in turn, supports Europe through the IMF. Europe, in exchange, offers loans to emerging nations through the World Bank. These developing countries then invest back in advanced economies by holding their foreign exchange reserves in Western bonds. It's a global game of passing the potato, though the potato consists of various promises. Every nation possesses someone else's IOU. Each commitment is backed by another obligation. It resembles a poker game, where each participant has borrowed chips from another player. The only rule maintaining this game is that nobody gets up from the table. The true arbiters, markets and central banks. However, there exists a fourth layer, the most influential of all: the markets themselves. Beneath each government bond lies a network of institutions. Hedge funds, pension funds, sovereign wealth funds, and central banks oversee assets totaling tens of trillions. They serve as the ultimate decision makers regarding credit. They determine which countries can secure low borrowing costs and which will face high premiums just to endure. When their confidence wanes, it can lead to currency crashes, government collapses, and the rapid restructuring of entire economies. While democracy establishes who holds power, the markets dictate who continues to thrive. Central banks, debt manufacturers. The ultimate market influencer in this system is the central bank, acting as a modern-day high priest. Central banks don't just oversee debt, they create it. Whenever the Federal Reserve or the European Central Bank purchases government bonds, they generate new money in return. The obligation of one balance sheet turns into the asset of another. Each dollar circulating in the economy corresponds to a unit of debt elsewhere. There is no existence of money that is free from debt. Every coin, bill, and digital dollar carries an invisible IOU marked upon it, the cost of waiving confidence. For many years, this cycle has continued due to trust. As long as investors are convinced that governments will pay interest, if not the principal, the system remains in motion. But what occurs when trust falters? We've witnessed this before. In Greece in 2010, the government's debt became unmanageable. Bondholders were left in a panic. Yields surged. The European Central Bank and IMF stepped in. However, their assistance came with austerity measures. Increased taxes, reduced spending, and widespread unemployment ensued. For one whole generation, bailout became synonymous with sacrifice. In Argentina, frequent defaults turned debt into a national affliction. In Sri Lanka, fuel shortages and political turmoil erupted when the government exhausted its foreign currency reserves needed to repay loans. When the system collapses, creditors become apparent. The IMF, credit rating agencies, and faceless bondholders who control entire nations emerge. Yet, even after a breakdown, the same pattern begins anew. Fresh loans take the place of old ones. Existing debts undergo restructuring. The system starts over with a different title on the same balance sheet. The secret: debt is designed to be rolled over. In the 21st century, the structure of debt is not meant to be repaid. Rather, it is intended to be continually refinanced. Governments nowadays do not plan to eliminate their debt at any point in time. This is not a conspiracy theory. It's simply the way policy works. Unlike individuals who are expected to pay back their loans, governments handle debt differently. They manage it like a subscription that renews, issuing new bonds to cover the old ones, a mechanism known as refinancing. Interest payments become the primary product, serving as the cost for stability. The global economy is now reliant on this interest. Much like a shark needs to swim to stay alive, The economy must keep rolling over its debt. The confidence in the current financial system outweighs the expectation of repayment. The United States is unlikely to ever fully pay off its $38 trillion debt. It will perpetually refinance it. For decades, Japan has successfully rolled over its debts, with a ratio exceeding 250% of its GDP, all the while maintaining near zero yields on government bonds. Investors are not waiting for repayment. They are keen to renew their commitments. Why? Because government debt is perceived as the safest collateral available. A U.S. Treasury bond is considered an asset rather than a liability. It is the bedrock of global financial markets. Financial institutions hold it, banks use it as collateral, and central banks treat it like currency. The entire system relies on governments never fully settling their debts, since doing so would eliminate the world's most reliable financial instrument. If Washington were to eliminate its debt entirely, banks and funds globally would suddenly find themselves without their most stable asset. The money supply of dollars would plummet dramatically, leading to deflation and economic collapse. Settling the debt would obliterate the core functionality of the economy. As a result, governments opt to keep issuing more debt, not carelessly, but in a measured manner. This debt acts as a vital rhythm for capitalism, circulating through every pension, mortgage, and market across the globe. That's why when politicians propose balancing the budget or reducing the national debt, they're merely promoting a facade. The aim is not to eradicate debt. Rather, it is to maintain it in a way that is manageable, sustainable, and appealing enough to ensure continuous belief in it. Because if that belief erodes, the figures cease to hold significance. Confidence will dissipate, interest rates will soar, and the economy, built on ongoing commitments, will come to a grinding halt. Conclusion: the hidden class transfer. The real truth about sovereign debt is that the intention was never to pay it back. The goal is to maintain the world's belief that it will be. It operates within a closed loop of trust. As long as that trust endures, the figures can stretch on indefinitely. However, trust is not uniformly distributed. When we claim we owe it to ourselves, that only tells part of the story. Interest payments do not circulate evenly throughout society. They ascend from taxpayers and workers to the institutions and investors holding the debt. In simpler terms, debt represents a transfer not just among countries but across classes. This explains why global inequality and global debt tend to rise simultaneously. The system benefits those who own debt while penalizing those who simply pay it off. If this resonates with you, it reflects a familiar narrative on a larger scale, from individual households to whole nations, and from nations to the global stage. Creditors aren't necessarily bad actors. Debtors aren't strictly victims. They represent two sides of the same machinery. The challenge arises when this machinery runs out of resources, when new borrowing fails to keep up with prior commitments. That's when the question, who's the creditor, transitions from being a theoretical concept to a personal matter. Because at the pinnacle of this global hierarchy, there isn't a single entity to blame. It's not China, Wall Street, or the IMF. It's all of them and every one of us. The contemporary financial system has effectively transformed debt into a form of currency. Governments create it, banks expand it, investors exchange it, and citizens rely on it. The distinction between debtor and creditor has become almost indistinguishable. Debt previously signified servitude. Now it represents balance. Yet if that balance ever shifts, if confidence falters, the facade will crumble, and we will recall what debt truly represents, a promise that cannot be sustained indefinitely. If this perspective has shifted your understanding, consider subscribing. History holds the keys. I can guide you on where to find them.